Hello. In part 1 of terms and definition, we will cover 7 terms and I have also written them in the form of blog. Before we go and jump to that blog and start reading about those 7 terms, let me give you one situation. So the situation here is, let's say you work for 5 years and you save 20 lakh rupees in these 5 years, and now you are planning to buy a home. Well, you also know that in 20 lakh rupees, it is not possible to buy a home in probably Bangalore, Hyderabad, Mumbai, Chennai, or let's say any metro in this country. Well, you go to the bank, you get housing loan approved for yourself, and then you buy a home worth 1 crore. You put your 20 lakh rupees, you take a loan of 80 lakh rupees, and you buy a home of 1 crore. Now, the home which you have bought will be called your asset. It is, yes, you have built one asset for yourself. And the worth of the asset is 1 crore. But the point here is your worth also 1 crore? No. You have put 20 lakh rupees. 80 lakh rupees is a liability on you which you will pay in future, right? So to find out your own worth, you know that you have to subtract the total liability on you from your total assets. So you built an asset worth 1 crore, which is your house. You have a liability of 80 lakh rupees, which is in the form of loan, house loan. And when you subtract this 1 crore minus 80 lakh, it becomes 20 lakh, which is your actual net worth. Well, this is what is required when you go and do fundamental analysis. And that's why it becomes very important that we know or have a familiarity with these basic terms like asset liabilities, because at the end of the day, a company will look very grand. Balance sheet will look very confused, it will have so many subheadings beside them. So it becomes little important for us now that when we are going deep into fundamental analysis, we start learning about the terminology in common man language as well. Well, I'm going to cover many other terminologies. In this part, I have just taken care of asset and liability. So you can go to blog section and then the terms and definition. So the very first thing is asset, right? Now, anything which we own is called an asset. Bank balance, we own that. Our money is there in the bank balance. House, car, pen I'm using, book, furniture, anything which I'm using and which I own will be called my asset. In another word, your money is your asset, and everything you buy with the cash become your asset as well. Vice versa, anything which you can sell and convert it into money will be your asset only. So in terms of companies, their assets are their cash in the bank account, their building, their cash yet to be received. They have sold the goods, have not received it from the distributors. That money has come to their account and it will be called their asset. To understand asset in a better format, we divide asset into two forms of asset. One is called current asset and another is called fixed asset. So cash in the bank account is company current asset. Anything which is immediately available or can be converted into cash within 1 year. So I sold goods. Now I will receive money from the guy within the same year. I have to. To maintain a very good liquidity in the company, no company will defer their payments of the goods which they have supplied to their customers or to their vendors, in fact, the raw material. So account which is yet to be settled in terms of when I have given my product to someone but not yet received the money will be also put in the category of current asset. Fixed asset is something which cannot be converted, but they are needed, right? Companies need land, they need real estate where they can manufacture, where they can have manufacturing unit, where they can have offices, so where they can set up their plant. So they are an asset for them. But the point is, can they convert them immediately into the into the cash? No, they cannot convert it. But this is mandatory. So similarly, there are many other assets which are put into the category of fixed asset because they are required for the operation of the company, but then they cannot be converted within a year. So I have listed down more fixed asset here, which you can go through this blog. I would say that in this class, even after watching this video, you must go and read this blog once. That's why I have maintained this blog in advance, right? Now you understood about there is current asset and fixed asset, and the major difference is their liquidity part. When something can be liquidated within a year, it will be called current asset, and something which cannot be liquidated but they are mandatory for running the organization will be called the fixed asset. Well, there's something called intangible asset also. So consider it through an example. Let's say a 50-year-old food company named Bader launched grape juice 1 liter per 100 rupees. What per liter 100 rupees. And then there is a new company called Zolo. It launches at 95 rupees. Now which one will you buy? Even though Zolo is 5% cheaper, there is a very high chance that you will go and buy it from Bader, right? Well, the Dabur and Bader I have interchanged just to give you an example and perspective. But then, yeah, you will go and buy it from the Bader. Why? Because this is a 50-year-old company which is already selling food related product. So you have a brand recognition and goodwill already on this company, which is helping them save a lot of cost on the marketing and already giving them customers which they have made from last 50 years, right? So can you value this brand recognition and goodwill? Well, you may spend a lot of money creating branding and goodwill, but how much your brand worth, it becomes very difficult to go and make it accountable or give it a number, right? So they are called intangible asset. You are doing research, you have spent millions of dollars as a pharma company to do research, right? And you have found a very new molecule on the basis of which you will probably, or a new formulation, sorry to say molecule, but the formulation on the basis of which you will go and launch a new medicine. Well, you can go and always account that this much of expenses you have done on the R&D, but then this formulation IP or the trademark will cost how much is very difficult to do. So that's why you have to understand one part, that when you will be doing fundamental analysis, you will have to go and take intangible asset into the account as well. Now the point here is, when you will do intangible asset into the account, why will you do it? You will do it because you have to do the competitive analysis. So competitive analysis may be the part of the qualitative analysis of the whole fundamental study, and that's why it is important that you understand this term intangible asset as well. Then you have something called liability. So you bought a house. So the example I gave you, in that example, you took a 80 lakh rupees loan. That 80 lakh rupees will be called your liability in your personal finance term. Companies do take loans to fund their operation and expansions. On behalf of government, companies collect tax and then company go and also deposit this tax. So initially they have to collect it and then they have to deposit it on the, every time they are going to sell. Now this is also a kind of liability which they owe. So every time they are going to sell, let's say 20 rupees tax they have to collect, and they will obviously collect and give it to the government, right? So these are called the liabilities which you have to pay. So liabilities are either a loan which you have already taken or a kind of promise which you have done that you will pay, right? So liability is something which you pay. Current liability and current non-current liability, they are more or like the same thing. Within 1 year, if you have to pay certain liability, you will call it current liability. For example, you bought raw material. Obviously, when you sell your product, you want other people to give you money within the same fiscal year. Similarly, you are buying raw material from someone, they are also running a company. They will say that, okay, we need our money in the same year. Though they are given you a credit line, you can buy produce from them, raw material from them for 2 month, 3 month, kind of credit line. But then after 3 months, you have to pay them. So, but they have to be paid within a year. That will be called your current liability. Non-current liability, something we have to understand, or let's say both of these two terms, current and non-current liability, if we have to understand from one example, try understanding this. Let's say you took a loan for your company to run the operation for next 20 years. And let's say you took a loan of 100 crore. You decided with your banker that, or you and your banker freeze that, what you'll do that initially you will service the loan in terms of giving interest every month. So you have taken a loan and you said that, okay, first 5 year I may not be able to give you the mool principal. What I'll be able to give you is basically the interest. So the interest is, let's say, 1% per month. Now this 1% per month is as per the terms and condition, right? So this interest which you are serving must has to be served, you know, and that's why you'll put that into current liability. However, the long term loan of that 100 crore, which has to be paid back in next 20 years on different intervals, will be called the non current liability, because they has to be settled after 1 year for a longer period of time. So I have given more examples on the current liability and non current liability. It would be good if you go and read this blog. Okay, so in summary, always remember, you have asset, you have liability. When you have the understanding about asset and liability, then only you'll be able to come to know what could be the net worth of an individual, one organization, right? Asset can be divided into two parts, liability can be divided into two parts. Common thing in both of them is the term. So within 1 year it will be called current asset and current liability. Most of the time companies will pay off their current liabilities using their current asset. And it is important to know here at this point of time that yes, current liability will be settled off with current asset, and this is a very good situation to have. When we will be doing the quantitative analysis and doing the ratio analysis, at that point of time you will recall that yes, understanding these two things in detail is helping me in terms of understanding the company's financial liquidity better, right? So go to this blog, read this blog, and this was the part 1 of terms and definition. See you in the next part.